Bet, as you said, we move in and out of our homes, or certainly with the loan product, it kind of goes back to that whole thing of, you say, marry the house, date the rate.
Yeah.
It seems to make good sense when you say, well, we're thinking, I've got 5 years before I retire, or 7 years, or I've got a contract and I'm gonna move after that. It seems like a pretty good deal, but there's a lot of folks now that are thinking, hey, I need to decide what I'm going to do here because they're coming due.
Well, here's what's happening. Again, this hybrid ARM had become, after the Great Recession, the most popular option for ARM loans. In a lot of cases, they've worked out fine. But you got to think of there's a couple things to think about. One is the initial rate on the loan is more or less an arbitrary rate. In other words, it has some connection to how the rate on these loans is actually determined when it starts adjusting. In fact, let me touch on that a minute. After the fixed period, these loans would adjust typically every 12 months. And they're going to adjust based on a index and a margin. Now, up until the last couple of years, the most popular index used for these hybrid ARMs was what we called LIBOR, London Interbank Offer Rate. And I won't get into the details of how did that become the index, because for one thing, you go, you're getting a mortgage in the U.S. and it's an ARM loan and it's tied to some rate in London. What does that mean? Anyway, we won't get into all that. But the point is that was the most popular index for years after the Great Recession and with the advent of these new hybrid ARMs. But then you take that rate and you have to add a margin to it. Think of the margin as sort of like a profit margin. And the typical margin would be somewhere between 2.25 and 2.25 and 2.75%. That would be added to the margin. So on these hybrid ARMs, the initial start rate for the fixed period would be roughly equivalent to that formula, index plus margin, but usually discounted a little bit below that result. So in other words, if you take your index plus margin and it's 6%, they might take that start rate for 5 years and place it at 5.5. So that's why it would be better than a 30-year fixed rate loan. But then what you had to know is after that 5 years, your loan's going to adjust every 12 months and adjust according to the index at that time plus the margin. So that is basically how they worked.